Welcome to this Twitter Spaces session. Before we start, just a quick intro about StockBits, like we always do. StockBits is the OG social platform for investors and traders. Our mission is to empower retail investors to become sharper and become the platform that hosts global conversations across asset classes, be it stocks, cryptos, NFTs, different investing styles, and experience levels. We recently raised $13 million in a Series B funding round from FTX, which is one of the largest crypto exchanges, and TimesBridge, which is the VC arm of the Times Group, with whom we have a strategic partnership to help us in our vision for the Indian markets. Joining me, as usual, for these fun and easy to understand market discussions is my co-host Sriram Iyer, editor-in-chief at Business Insider India. And our guest for today evening is Aashish Sommaiyaa, CEO at White Oak Capital, which is a highly reputed investment management and advisory firm. Aashish himself has over 20 years of experience in the mutual fund industry and is a highly regarded voice when it comes to all things markets and mutual funds. Aashish, thank you so much for taking the time out and joining us.
Yeah, hi Yash. Hi Sriram. Thanks for having me.
All right. Aashish, I'll take the first question. The past couple of weeks have been marked by very high volatility. One day it's a sea of red, the other day we have a big pullback or a relief rally. What is your take on the markets, and do you believe that the worst in terms of the market sell-off is behind us?
Yeah, Yash, like you rightly mentioned, very, very high volatility. And if you take volatility as a symptom, basically what it means is that the market at large doesn't seem to be able to make up its mind in any definitive terms as to, what is the way forward and what exactly are the implications of whatever is happening, with Russia and Ukraine and the rest of Europe, NATO, etc. So just to give you an example, last Thursday, if you recall, the mid cap and small cap indices were anywhere between 5 to 6% down, and the Nifty was more than 4% down. Then on Friday, there was like a smart recovery, and a lot of people would have declared victory by Friday afternoon. But then Monday again, like a sharp fall, and by Monday afternoon, again a big recovery, right? Yesterday, of course, was a holiday, and then again today, we have seen a downfall. So what does this entire amplitude of swings tell you? High volatility always tells you that people at large, or the market at large, is trying to price in a lot of significant unknowns. Now, amidst all of this, it behooves any retail investor not to make out any definitive conclusions. So unfortunately, for what you asked, that, is the worst behind us? Unfortunately, I don't think so. And I don't even know why. The reason is because no way to know. These are unprecedented things. Like, for example, when demonetization happened and 18 lakh crores worth of currency was said to be defunct, we didn't know. We'd never faced such a situation. Same way when COVID happened and the whole world came to a standstill, we had never been through such a situation. In the last few decades, a lot of wars have been proxy wars. This is the first time we are actually seeing like a direct war, where Russia is trying to occupy Ukraine. And the Western world is not even providing any proxy support or tacit support. It's literally like they are providing arms and ammunition and monetary support to Ukraine to fight back. So I'm just saying we are in unprecedented times, and it behooves all of us not to draw any definitive conclusions. And I would say that, probably unpopular opinion, but to begin with, I would say, sometimes it's best not to do anything.
Ashish, I just wanted to say that when a bear attacks, the safest thing to do is to act dead.
Act dead, yes.
Yeah. If you can pull that off, I guess we'll all, anyone who has their life savings in the market.
Yeah, I said that because, generally we have an action for, we have a bias for action, in the sense that when something happens, we need to be seen to be doing something. But, till the not to fish in troubled waters is another way of saying it.
Yeah, absolutely. There is, it's really even, I happened to sort of chance upon Maudlin's note, John Maudlin, one of the US's thought leaders in the US market, and he had even he is not giving out any clear sort of picture of what could possibly happen with all his experience and expertise. and he's kind of laid out 2 or 3 different scenarios that could follow the next few months. I could get into the depth of it a little bit, but I don't think the idea is to simplify it. So I think he doesn't know whether it's just before this war happened, we were very sure that we were in an inflationary world, right? Every prices were going up for everything across the world, and it is quite possible that even that could slow down a little bit as the global growth slows down because of this war. And at some point it may start to seem like Ashish, you said, a bias for action, a trigger for action, saying, oh my god, inflation is not a fear anymore. Is that true? And again, I think he also wants to that at this stage it's good not to reach any conclusion. um, let's see how it plays out.
Yeah, absolutely. Yeah.
Yeah, Yash, can I take the next question? Because
Yeah.
I believe in more sort of, yeah, Ashish.
Yes.
We've had a couple of chats in the past, and you know my general approach. Why don't we sort of talk about? I mean, because we're calling this lessons for retail investors.
Absolutely. Yeah.
Um, so how do we say? Let's say, just as much as we celebrate success and great calls, and a lot of money made in one call or another, what would you say that you sort of miscalculated? Obviously, because you didn't know there was a war coming, right?
Yeah.
So what would that be? And the point that I'm trying to reinforce is even the best in the business are bound to make mistakes. So
Sure.
why don't you share some personal experiences here?
Yeah, so just couple of clarifications, Sriram. When we say that best not to do anything, just for clarification right now, because on a lighter note, someone might think, if there is nothing to be done, then what are we discussing? So just to clarify, just to clarify one thing, we need more data or we need more clarity. So you should always let situations evolve before you jump to any definitive conclusions. And I think that is, when we say don't do anything, it means next few days. It doesn't mean haath pe haath dhare, baith jao, and just kind of forsake all your investments. That's not the point. The point
No,
is
no, no,
that
not
when there
true.
is a lot of flux and there is a lot and an evolving situation, it's best that you let more information or let more data come in. But on your question, I think what I've always shared with our investors, especially to simplify things for them. See, in the last few months, especially October onwards, right? Our market, if you see our economic performance, corporate performance, GDP growth, in some sense, a recovery. Yes, very rural, urban, etc. A lot of concerns have been raised. The point is that in general, our economic performance or corporate performance has been better than what we would have thought way back in 2020. But successively, we have faced headwinds, first because of China and the China tech sector, then because of US inflationary expectations, Fed and US tech sector, and now because of the war. Same way, if you see even 2008-9, it started with the US. So what I'm saying is even COVID, before we had 1,000 cases of COVID, we were 40% down. So what I'm trying to explain out here is that by and large, when the markets tank, instead of focusing on prices and instead of focusing on the fall of the market, I think it's very important to understand. You cannot attribute specific reasons, but generally speaking, it is important to understand why whatever is happening, why is it happening, or what is driving whatever is happening at a current point in time. And if you react to price movements, if you react, just because market is 20% down, 15% down, or 40% down, so if you draw conclusions because of price movement, I think there's no bigger mistake than that. That's the most common mistake which people make, which is reacting to prices. So if you were bullish in October 2021 and you are bearish now because prices have fallen, and there are so many things which are afflicting our markets, or say FPIs are withdrawing. So whenever you react to flows, whenever you react to prices, I think that's the biggest mistake that you can make, because given that the reasons for this fall are beyond our borders, it's best that we don't read too much into it. Because when the dust settles, you look at all the examples of 2008-9, 2020, at some point in time in 2016, 15, 16. Each of the times when there is a big outflow of foreign money or there is a big precipitation in the market for reasons beyond our borders, if we react to it, what will happen is we'll be left out of the market. And when the dust settles, you will see all the money and more coming back, and you will just lose grip on the market. So I think the most common mistake which has been made by people that I speak to is basically reacting to prices or reacting to flows. I think that can really push you out of the market at a wrong time.
All right, that's awesome. Reacting to prices or flows is a big mistake, and that's something that retail investors should avoid, because obviously, even if you look at today's FPI outflow number, a lot of people would be really scared looking at almost over 4,000 of outflows. But we have the first question coming in from Ramakrishnan, who's one of the listeners. You can unmute yourself and go ahead and ask the question to Aashish.
Sir, actually, in small cap today is going up. Mid cap and large cap is down. What is the reason? I don't know. Still in market is same position in further in war continue or downing or upping. I don't know. What is the situation in current market in control on government? Any development strategy follow?
I will
No, I
leave the
think
strategy part to Aashish, but when you are in the market drama, you should not
Yeah,
always ask for the government's intervention.
Yeah,
That
sentiment,
defeats the
government
purpose for
sentiment,
yeah.
any positiveness.
Yeah.
Investors are all are hugglers till now, but there is no guarantee in government side.
Oh, see, I think Mr. Ramakrishna, what we have to keep in mind is that there is a big difference between expecting government intervention versus believing in a market economy or a free market or a capital market. In fact, we don't want the government to intervene, right? What is the biggest criticism? One of the biggest criticism, I think he's got dropped off, but just for everybody else's benefit, I think the key point is that one of the big criticisms of government intervention, for example, is that whenever the market falls, the government insists on some sovereign institutions to start buying and support the market, etc., etc. While even in the Western world or at some points in time, these kind of things happen, but I don't think that is the healthiest thing, or that's not something which one should really look out for. I think that is something we all should keep in mind if we believe in a market economy.
All right. So let's move forward. And like I was saying, there's a popular saying that there is always a bull market somewhere. And in this recent sell-off, we have seen relative strength in commodities and energy names. Aashish, what is the current weightage of commodity players in your portfolio, and how are you looking at them in the broader context?
So Yash, I think this is something frankly, I'll try and answer your question, but before that, something peculiar to no blanket answer, but something peculiar to how White Oak manages money, which is that we generally don't have global commodities in our portfolio. Not because you can't make money with them, but the key point is that when you are invested in global commodities, you're essentially taking macro bets. See, I think a lot of active managers spend a lot of time in saying that they give great weightage to management quality, understanding governance, understanding management quality, etc. But when you are dealing with global commodities, I think one thing to keep in mind is that the best of managements, they can be low cost converters, or they can backward integrate, they can forward integrate, they can be efficient. But the best of management does not control the price of commodity. So they don't control the price at which they get the raw material, and they don't control the price at which the finished product goes beyond the point. So as a result of this, investing in commodities basically involves taking macro bets. There is precious little you can do purely in terms of bottom-up company specific work. So we generally don't end up owning global commodities in our portfolios. But by and large, on your question, I personally think that it's a short-term thing, right? It's a short-term thing on the geopolitical front. But otherwise, it won't be a great idea to react to what is happening right now, and hence, build a bull case for commodities in general. The other thing to keep in mind is that there are many, contradictions in how commentators or how investors are looking at the market. On one front, just before this geopolitical issue started, on one front, we were very concerned that if inflationary expectations go up, if the US is raising interest rates. So basically, when raising interest rates, when it sets the cat amongst the pigeons, you basically mean to say that raising interest rates will kind of cool off the economy. So if you are worried about raising interest rates, then you cannot be bullish about commodities to that extent, right? So either you can be on one side or on the other. But purely given the current scenario, given the geopolitics, I don't think one should really, given the current bump up is because of the geopolitics, I don't think one should bet on it.
On that note, I want to come in with some breaking news here. OPEC meeting has ended, and they have announced that there will be a 400,000 barrels per day increase in output, because you were speaking of commodities, Yash and Aashish. Just thought I would flag this off while you're on Spaces. There is news always coming in. So this is sort of in line with what the market expectations were. So, and I think the simpler way to say it is, all the other oil producing nations are trying to capitalize on the high prices. Like Ashish said, that this commodity rally, the increase in commodity prices that we are seeing, it is very likely to be a temporary phenomenon as long as the war lasts. So as fast as they go up, whether it is oil, coal, we've seen Vedanta being the top gainer this year so far, right? I mean, we've seen a spectacular rally in that share. But whatever commodity it is, people are paying additional price for the scarcity that they expect, because of whether it is supply constraints or production constraints, whatever that might be. But yeah, so once the dust settles, like Ashish says, the prices may come down, and then you may be sort of holidaying somewhere and not know where to sell the shares, right? So I think that's the word coming in from Ashish, and this is the news coming in that the oil production is going to increase, because much of the world is not going to be allowed to buy Russian oil, and therefore Saudi Arabia and other OPEC countries are trying to make the most out of it, because oil prices are well past 110 now, so $110 a barrel. Back to you, Yash.
Yeah. Shyam, you want to go next?
So if not commodities, then sort of let's sort of talk about other sectors, Ashish, that have been on your radar
Sure.
right now, where the prices, like you said, the price is not the trigger, macro is not the trigger. Then what are the good quality management companies with pricing power? I think these are the highlights that you have pointed out so far, right?
Sure.
Good quality management, pricing power in the business that they are in, and of course are now available at a valuation that is attractive, but you would still not buy.
Right. No, so at our end, I think so. Basically, we are not sectoral investors. We see ourselves as in some sense, relative managers. So, which means what we will look for. We will look for, obviously, like you rightly pointed out, good governance, good quality. But beyond that, at any point in time, two, three nuances. One is we are looking for companies that will generate free cash flow over and above their cost of capital, right, and available at discount to intrinsic value. The other important thing is we'll focus a lot on portfolio construction. So generally speaking, we are not a macro or a top-down investor. We will construct based on our investment criteria. We will construct a bottom-up portfolio, but then use use a reference to the index or use certain top-down considerations purely for risk control or for balancing the portfolio vis-a-vis multiple macros. So we are not really a sectoral investor. You will find our portfolio having investment in practically every sector. But since your question is related specifically on sectors, I would still answer it. I would say really, if you ask me, in the recent past, what has seen massive underperformance and it's not it's not because of anything to do with the sector. I think a lot of it is headwinds. So financials, if you ask me, the top banks, private sector banks and a couple of large PSU banks, for instance, despite consistently improving performance and despite improving guidance, I think that prices have been headwinded because of what we are seeing. It's the largest sector in the market, also heavily owned by large institutions and even FPIs to some extent. And I think they are seeing headwinds purely because of market conditions and not because of fundamentals. So massive underperformance in the private sector banks and financials in general. If you see 2020, 2021, for example, a lot of capital market companies were darlings of the market, right? And I think even they have seen significant underperformance despite the fact that their business fundamentals continue to improve. Similarly, if you see another large one, which is, say, for example, IT, right? Now, IT also, even the large IT companies, IT, ITS, even some of the mid caps, despite significantly good performance, they also have seen headwinded, action. And last, I would say, while we don't have a big exposure, I would say that eventually autos also will be something to look at. So this is what comes to mind, top of mind on your question. These are anyway large sectors of the market, but I think that they have kind of led the underperformance in recent times.
All right.
Yes,
Ashish,
one thing, just one follow-up, Ashish. When you say that they have underperformed, and of course, it's pretty much any portfolio has a big chunk of banks and financials.
Sure.
Would you say that would be if and when this entire crisis subsides, whether it is the
Yeah.
war, whether it is the inflation fear, or inflation is not probably going to subside unless there is a growth slowdown considerably. Are these the ones? Are these banking and financial stocks? Would they be the first to bounce back? Is that a
Yeah.
good way of
So,
summarizing it?
yeah. So, I'll tell you, Sriram, something very good question, something related with what we have been discussing in the last few minutes. Look, like I mentioned, I don't think that the headwinds in our market post October, November. I don't think that the headwinds really started with anything to do with India. It was a kind of global risk off for multiple reasons. Like we said, China and China tech sector, US tech sector, and then the war. So, given that significant part of the fall has been led, or and by the way, it's not yet panic. And from the peak, we are, say, small cap index must be about 15-16% down, mid cap must be 12-13% down, and Nifty must be about just 10+% down, maybe 12% down, right? So it's not capitulation or panic, but whatever we may call it, the fact is that in the last 3 to 4 months, a lot of the market underperformance or poor performance or headwinds is because of FPI outflows and because of a global risk off, correct? Now, if you ask me like I said, I would desist from predicting anything about the war. But one thing I can imagine is that suddenly you might see the risk of turning into risk on based on some news which might come up in the near future. A full, like we have, like a full blown NATO versus Russia, nuclear war and all those kinds of things. The worst comes to people's imagination if you follow the news. But the point is that if you imagine that that's a low probability event, and second is if you think that eventually with all the backdoor, what you keep hearing about negotiations and ceasefire and peace talks and all, these kind of events, what is most likely to happen is that suddenly one fine day the clouds start to give way. So what is likely to happen, based on past experience totally, that over the next, say, 3, 4, 6, over the next, say, few weeks, not very far from here, over the next few weeks, you might suddenly see that the risk off turns into risk on. And past behavior of FPI flows has always shown that for any 3 month, 6 month, 9 month period, they may trickle out or they may be selling. But when the dust settles, it becomes like a sudden U-turn. And eventually they buy back more than what they've sold. This has happened, by the way, in 2008-9. It has happened in 2020. It has happened in 2015-16 also. So if that were to happen, sorry for the long answer, but if this kind of scenario were to play out, then I think the sectors which I named, they would probably outperform by a big margin if there is any reversal. That's what I would put for your consideration.
Awesome. Souvik, you have asked to speak and we've given you access. Sorry, I forgot to come to you. Please unmute yourself and ask your question to Aashish.
Yeah, hi. So I had basically two questions. One was that it was mentioned about not much reading into the price fluctuations in a crisis. But shouldn't that be the perfect time to average down your portfolio, especially when most of the companies in Indian scenario are not affected much by the Russia-Ukraine conflict? Uh, and secondly, something is happening tomorrow. That is, NSE will be allowing to buy FANG stocks through IFSC receipts. So, would you help us understand the nuances of that? How it is different from directly buying a stock from, let's say, an app called Vested or IND Money?
Sure. So, Shouvik, on your first question, on your second question, I would have to defer to someone else to answer it. But on your first question, uh, see, what I was trying to say, if your reaction is, for instance, like you narrated, if your reaction is that you completely conclude and you understand that the prices are down for nothing to do with us, but prices are down for certain exogenous reasons, and you would like to average, or you think is the right time to buy, I have no quarrel with that. You are bang on. You can certainly do that, and maybe you should do that. When I said that, don't don't react to just price fall or to just the flow related news. What I meant to say is that if you start concluding that because the market is 20% down, there must be something bad. On a lighter note, in spirituality, it is said that all answers lie within. What I've seen is that even in stock markets, by and large, in the markets also, sometimes people try to apply that logic. When our market falls, we start looking for reasons in our market. Yeah, our market is not falling for reasons related to our market. Our market is falling for many, many things, in the entire, globe that are happening. So that's where I was coming from when I said that don't read too much. Like I'll give you an example. Sometimes nowadays tech stocks are all the news, and many tech stocks, their share prices have fallen, say, 50-60%. So people are concluding, oh, these are bad businesses, bad promoters, bad managements, इनका कुछ future नहीं है. Now, I am no one to pronounce judgment. I'm just saying that if your reason to think that way is just because the price has fallen 50%, then probably that's not the right way to look at it. So I was purely narrating from perspective that don't draw conclusions based on price movements about the goodness of something. But if your reaction is, the way you are narrating it, you are absolutely, you and me are on the same page, because what you are saying is that, if price has fallen, and I understand that the price has fallen for reasons not attributable to the business, so I should average. I completely agree. There's nothing wrong with that. On your second question, which is that, what's the difference between buying through, say, in money or vested versus buying, through NSE in Gift City? I actually don't know the operational nuances. I know that both of them work on LRS, both of them fall under the same limits, but I'm really not clued on to the operational nuances. So maybe if Sriram or Yash know about it, maybe they can help answer this.
Operationally, I mean, the nuts and bolts of how it will work, even I am not very privy to that. I think it has to start for us to be able to speak to some people and figure out, how it works and what are the challenges, etc. So we, maybe we will reporters will work on this and figure out. I think it's the NSE platform itself has given a sort of how to do this kind of process and those kind of things. So you can take a look at that, and I think it's a good question. I think this is mostly for people who want to trade in US stocks. So therefore, it's you can buy your Amazons and Teslas and to whoever is interested in those, and that's what it is for. And like he said, Aashish said, it's under the LRS scheme, which is the liberalized remittance scheme, which is essentially means that you have a upper limit of $250,000 in a financial year. So those are the broad details that we have so far. What and how to and how much in a day, in a month, etc. I think that I would say not in a position to make a clear sort of give you a clear instruction on that. But I think it's definitely something it's interesting. And I would say, Ashish, I would add to Ashish's point on the watching the price and then sort of acting on it. I think it's really about your risk appetite more than anything else as a retail investor. Because right now, I would sort of hark back to Ashish's first answer, where he said that we don't know how big a crisis is this is and how long it's going to last. So yes, a 20% correction might seem attractive, but what if the downside is another 30%, or whatever that number is, right? I mean, do you have that holding power? Is that and therefore, is 20% a good time to average or 30% a good time to average, etc. So I think the idea is to say that okay, um, uncertainty is the problem, not exactly the price, right? Ashish, did I summarize that right?
Yeah, absolutely, absolutely. We are on the same page.
Yeah. So yeah, back to you, Yash.
And it fits perfectly with our newsletter's header today, one day at a time. So don't try to get adventurous right now, and don't do anything, is what Ashish has been saying. But Ashish, this one is right up your alley, and it's
Mhm.
something that has confused a lot of investors, that despite the retail investing boom, record mutual fund inflows, and SIP book at over 11,000, AMC stocks, HDFC AMC, UTI AMC, or even the most recently listed Aditya Birla Sun Life, they are down 30-35% from their all-time highs.
Mhm.
What explains this underperformance?
You put me in a tough spot, but I'll just answer to the best of my understanding, and please take it with pull me out of my because I've been CEO of a listed AMC in the past, and at the same time, I'm part of the industry. So please take me out of my AMC hat totally, and please I'll reply as respectfully, or with as neutrality as I can. But
We
I
are all
think
friends here, Ashish.
here's the problem. Here's the problem. Again, it's like this, that the industry is growing very, very rapidly. But in the industry, there are many players which are listed. I mean, sorry, there are few players which are listed, and there are many which are not listed. So what happens is that if a lot of players in the space which is not listed are doing very, very well, and they are growing very well in terms of assets, in terms of client acquisition, most importantly, in terms of their scheme performance, and hence also in terms of their profitability. So what will happen is that if you draw inference about the AMC industry's performance or prospects purely based on two or three listed players, then I think you will miss out on the, of course, an investor, a stock market investor can only act on what is listed. Unfortunately, currently, maybe only temporarily, unfortunately, currently, the scenario seems to be that the listed ones seem to be losing market share. And it's only incidental that a lot of the guys who are gaining a lot and gaining a lot of traction for all the reasons I said, unfortunately, they are not in the listed space at this point in time. So nothing to do with the industry. I think it
For
is more
you
a
to
case specific. It's more case or company specific things which might be playing out right now.
So Ashish, should we read into these lines or should we leave it there?
No, I mean, if you have a follow-up,
So
see,
yeah.
I'm known to be direct, and I sometimes do get into trouble for that. But if you have any follow-up, I'll do my best to answer.
As in, is there a listing plan and how will it work?
Oh, so yeah, I mean, so no, my firm, I mean, we've actually, if you see our retail asset management, we just acquired the asset management company of Yes Bank. We are yet to even launch our mutual fund operations. As we speak right now, 76% of the assets of 6 billion that we manage, pretty much everything is global money invested into India. Locally, we are, very young and new. Only the PMS and AIF mutual funds not even launched. So we are really far from that kind of
I know, but I'm saying
scenario.
eventually, that's why I wasn't framing it.
Yes,
Uh,
eventually, yes, eventually. I mean, I would always defer to Prashant, who's the founder, to opine on this. But eventually, I think it's a realistic assessment. Eventually, if you want to professionalize a company, if you want to, if you want it to be a valuable creation, then certainly. Most importantly, for professionalizing, I think it's the best way to go.
Interesting. What you mentioned 76% of the money that you manage is from foreign investors, portfolio investors.
Yeah, absolutely. Absolutely.
So,
Because White Oak has become a mutual fund license holder or a fund company in India only in the last 3 to 4 months. But we've been running India Equity Mutual Fund, say in Europe, for over 3 years now. So
yeah.
one of the largest European funds investing into India is a fund managed by White Oak Singapore.
Oh, that's amazing. No, so I mean, I was aware of it. I wasn't sure about the numbers, so I just thought I'll confirm that once.
Certainly, yes.
But what I was saying is so the question is, I think then it's pertinent to ask you, to sort of give us a perspective on the what is their anxiety with India, considering the kind of money that has
Right.
flown out,
Sure.
and what would sort of put that anxiety to rest.
Sure. So, Sriram, great question. What I learn by speaking to my colleagues outside the country, or whenever I have opportunities to speak to any of our global clients, what I understand is, and I have tried addressing this, that it's basically a global risk-off kind of thing. If you ask, someone like us, which is a single country India dedicated manager, we are actually not witnessing negative flows. We are actually, if you ask me, from 1st Jan 2022 till date also. So forget last 4 years. Last 4 years, we are among the larger FPIs. So forget that. But even this particular calendar year, we are not actually net negative. So what I'm trying to say is that if you ask me our experience within the White Oak Group, if you ask us our experience as a dedicated single country India manager, and whatever client segments that we are addressing, say in Europe, US, wherever, we are actually a net positive inflow. But that's the answer from a single country manager. The reality in the market is that you are seeing significant selling and you are seeing significant outflows. So how can that be? And that's why I've been saying it's a global risk off. So, just for simplicity, if somebody withdraws $100 from a global emerging markets fund, then, it may not be a sell call on India, but, willy-nilly $15-20 will go out of India. If somebody has $100 reduction in their global equity allocation, it's not a sell call on India, but willy-nilly some $4-5 will go out of India, correct? Or maybe $3 will go out of India. So let's not give ourselves so much importance. Frankly, nobody wakes up first thing in the morning and says, okay, today I'm going to sell my India portfolio. Unfortunately, we are not there yet. Right now it's only we are some part of an allocation. And Jagjit Singh, there was this ghazal, right, which says "Apni marzi se kahan apne safar ke hum hai, rukh hawa unka jidhar ka hai udhar ke hum hai." So we are part of this global thing right now, and we might be swaying with what is happening in the global markets. But if you ask an India specific single country guy, people are constructive. In the last couple of years, the interest has actually gone up, to be honest.
On that note, I had one more question. Yash, I'm sorry if you don't mind.
Go ahead.
Which is, there is another opportunity that I can see sort of stemming out again at the end of this crisis, whenever that is, right? So before this war broke out, and after what China did with its tech companies in late 2021, sort of. People were talking about China plus one, right? And now you have a China plus one opportunity and a Russia plus one opportunity. Would that be a right reading? A lot of money that was not going to go into Russia anymore is possibly headed towards other markets. And again, out of that 100, maybe $4-5 will come to India as well.
So I actually may not really benefit, or may not really redirect a lot of flow. I mean, because if you take the overall MSCI index, it might probably result in some redistribution of weights, but I don't think that number would be very, very large, and then again would necessarily come India's way. Plus also, if you actually compare India with a lot of emerging markets, see, Russia, for example, is heavily, if I'm not wrong, 50-60% of Russia market cap weight is just energy as a sector, right? Now, India on its own has some fabulous characteristics, which I don't know if people have noticed. It's probably even better than China, by the way. It's the most diverse emerging market that's out there. When we present to global clients, there's something which I always put up as the first thing to talk. It's the most diverse market. So what do I mean by the most diverse market?
Ashish, may I just interjection?
Sorry,
Do you mean diverse as a consumer base
I
or
meant
diverse as?
diverse. Yeah, sorry, I'll just specify. What I meant diverse is that lowest concentration of top two sectors amongst any emerging market that you can compare. So, for example, if you take the top two sectors in India, financials and IT, maybe more like more like 45, 47%. If you take China, Russia, Brazil, Taiwan, anything, you will find that in most countries, the top sector, in many countries, the top sector itself is more than 50%. In many countries, the top two sectors are over 50%. So one measure of diversity is that India is not concentrated in just two sectors or three sectors. We have listed companies in every sector. Second is we have the highest number of listed companies. And third, and very important, within every sector, we have a mix of small, mid, and large cap. That's what I meant by, so there is a wide variety of sectors. Within sectors, there is wide variety of companies, and there is a large number of listed companies. By the way, people who compare our market with US and discuss alpha, etc., I'll tell you something shocking. In the US in last 25 years, talk about active management and alpha potential and diversity of markets. In the US, for example, in last 25 years, market cap has gone up 3x, but number of listed companies has become half. Now you compare that with India and talk diversity as an emerging market from a foreign portfolio manager, from a FPI's eyes. We have larger number of listed companies than US, and we have more diversity in the listed space.
That was lovely, Ashish. I think that is one perspective that rarely comes out of these conversations. No matter how many market conversations you're part of, because like I said, I am more of a fundamental guy, so I was like, okay, maybe he's talking about diversity in a different context, but I think that was absolutely wonderful. Thank you. Back to you, Yash.
Yeah, that was a great answer, Ashish. So coming back again, to the earnings season, Q3 lacked any real fireworks, save for IT and banks. Most of the sectors reported in line to, below than expected results. What have you factored in terms of the full year when it comes to earnings FY23 and beyond?
So, of course, I mean, our team would maintain models for individual companies, but since you're talking at market aggregates, what I've seen on the street when I read sell-side research, what I've seen is that by and large, people seem to be thinking that Nifty EPS number for year ended March 22, after third quarter result season was complete, and whatever new estimates that we saw, I saw that Nifty EPS March 22 number is generally 735 to 740 kind of numbers that people have been talking about. So from that perspective, I think on course, it's not, I mean, right now, by the way, the market is not terribly expensive. And, given all the uncertainties, if you still kind of stick your neck out and dare to pronounce a 1 year forward Nifty EPS number, most people seem to be thinking it is in the vicinity of about 870. Now that 870 makes 1 year forward below 19 times, which is frankly not terribly expensive. It is actually it is below the 10-year average on 1 year forward PE multiples. So that's what, I mean, of course, given the uncertainties, we should not bank on that 870, 875. It can go either way. It can go.
I think the big factor there will be the global inflation.
Absolutely.
Right? Commodity prices. And I think if somebody made these estimates in mid-Jan, and there are like between mid-Jan and mid-Feb, let's say, right? I don't think war was part of the calculation.
Yeah, so this is after result season, but you're right. That's why I myself caveated it, saying that by and large, people seem to be thinking 870, but you should discount it a little bit. So even with a 5% lower number, you will not be exorbitantly expensive at 16,500. That's what I meant to say.
Cool.
All right. Jigar is another listener. He has a question for you. Jigar, you can unmute yourself and ask the question.
Hi all. Good evening. So I had a question to Aashish sir. So as a fund manager, how do you see the current situation? Like I'll sort of elaborate the question. So since there is this war going on and we are falling since the last, I think, 4 months, right? some stocks have fallen 20, 30, 40 odd percentage. So how do you like evaluate this? Like I should be buying, I should be waiting, or like what goes in your head as a fund manager?
Yeah, sure, Jigar. So, I'll just clarify one thing. I have been in the investment management industry for 22 years, but I have been CEO for last 9 years. And personally, I'm not a portfolio manager or a stock picker. But the beauty about what I love about my work is that I meet more number of investors practically every day and every week than what most people would meet in a lifetime. So, from an investor's perspective, I can tell you a couple of important things. See, first is when you talk about, see, one thing I caught when you were talking that we've been falling for the last 4 months, and many stocks are 20, 30% down. Now, whether you are a professional fund manager like my company or my colleagues at White Oak, or if you're an individual investor, I would urge you to do one thing that do not deal in individual reference points about stock prices. Even if you're managing money personally for yourself in your own demat account, please try to keep reference point of some benchmark, right? Your benchmark could be some mutual fund NAV. Your benchmark could be the index itself, NSE 50, NSE 500, or if you're dealing in small cap, mid cap, then the relevant. Because what I'll tell you is what you should keep in mind is that portfolio managers are always evaluated. And by the way, it might look like I'm digressing, but I'm deliberately going this route. Portfolio managers don't actually think in terms of absolutes like 20% down, 30% down. For an investor, when you actually give us money, our job is to ensure that it is best deployed in the equity markets. And when we are fully deployed in equity markets, we will compare our performance with BSE 500 total return index or Nifty 50 total return index or some such index. Now, in the last 3 to 4 months, what I've seen is that funds would be down by some funds would be down 8%, 10%, 12%, or some such number. But by and large, it is 8, 10, 12% down. Individual stocks are 20, 30, 40% down. So if you are managing money for yourself also, please ensure that you are not just dealing in some absolute numbers like I'm 20% up or I'm 20% down. Please compare it with a benchmark. Because if you started investing in 2020 and by 2021 you thought that I'm probably a great fund manager and I know exactly what to do, then you should compare yourself with the benchmark from 2020 to 2021. And then on the downside, also compare yourself with a benchmark from the peak in October to this point in time. So I think having some benchmark or reference always keeps you tethered. You're always grounded to what it should be. And I'll tell you why I said this, because in reality, if you're 10% down, Nifty is probably 10, 12% down from the peak. Small cap index is 15, 16% down from the peak. So massive FII selling, lot of terrible news all over the world. But let me tell you, it's not some disaster which has happened when it comes to mutual fund NAVs or the broad market index itself. That is the first thing which I'd like to clarify. Second thing is that what should you do now? So in the beginning, I said, I'm not talking from a weeks or months perspective, but for next few days. Why does the market have such crazy volatility? Sometimes you're 3% up, then 3% down. Within the same day, there is a 4, 5% up and down. It basically means that the market at an overall level is not able to make up its mind as to what is going to happen next. Correct? So high volatility actually means that there is a lot of uncertainty and the market is trying to price in a lot of unknowns. At such times, for the next few days, it's better not to make any definitive conclusions, which means it's better not to do anything. Be on the side, wait, let information come in, let things settle down, and then kind of, try to venture back in. That's how I would put it.
This reminds me of a Warren Buffett quote because everybody who follows market loves it. I thought I'll take this opportunity. Jigar, the quote goes, "A horse that can count till 10 is a remarkable horse, but not a remarkable mathematician." So it's always important to know what you're being compared to. Just on a lighter note.
Interesting. One more question from my side, Aashish.
Yeah.
We've seen a lot of these new age consumer tech companies get badly beaten down in the last couple of months. down almost 40, 50, 60% from their all-time highs. Are you starting to turn positive on them? What is your view on these companies, or are they still a no-no for your from your point of view?
No, I see. Frankly, we've never been in the camp. We've never been in the no-no camp at all. In fact, White Oak as a group does have exposure to some companies selectively. I'll just put it this way. Look, this is one of the examples I gave earlier, right? When I was saying that don't make conclusions based on price movements. So some of these, I'm not saying all of them, and I'm not getting into specifics, but that's a classic case where in mid 2021, everybody was quoting that how many people are there in India. 135 crore people, 70 crore 4G connections, and we have 12 crore people who are using online food delivery and ride on demand, and we were quoting all these statistics. And then when the price started falling, then everybody said, okay, this is crazy and stuff. So I would put it this way, that this is one place where everybody is reading too much into the prices. Staying with the statistics, our tech sector there may be issues with individual companies and their performance and their managements, and it's absolutely fine to criticize based on valuations, to criticize based on certain management actions. That's all perfectly fine. I respect all of that. But you cannot ignore these companies or ignore this sector. By and large, you cannot ignore the sector. I'll tell you the reason. The reason is because right now, when did it start falling? It started falling in sympathy with what happened in China tech, and it started falling in sympathy with what happened in US tech. Okay, if those things hadn't happened, not necessarily that we would have had such an adverse reaction in our own market. So one is that somewhere it has got correlated. I don't think it deserves to get correlated. You will always look at company-specific sectors, but by and large, our tech space did not have to get correlated with US tech space. The reason being that before this fall came, the US had a 13-year dream run. COVID was just some 3-4 week phenomenon for them. Otherwise, they've been on a tear. Before this fall, NASDAQ 100 10-year CAGR was 25% year on year, 10x in 10 years. After that rally, they are seeing what is happening. India has had no such, our market has not been on a tear. For 7-8 years, our market was in the 8,000 to 12,000 range. We practically went nowhere. And some of these companies have come in the market only 3 months or 6 months back. Now, based on these 3 to 6 months, if we are going to write off the whole sector, by 2025, this entire consumer internet space is going to be in a different zone altogether. Just staying with the data, in 2020, India had 22 crore OTT users. By 2025, it is projected to be 55 crore OTT users. In 2020, India had 12 crore users of ride on demand and online food delivery. That number is expected to be some 25 to 30 crore in the next 5 years. 4G has changed the face of the whole internet space. What will happen when we have 5G? So I think that, it's fine to criticize based on price movements, valuations, some management conduct, etc. But, ignore at your own peril. So I don't think it behooves all of us to look at it closely and study and try to understand where value will be created.
I agree with you, Aashish, on the future of this space. But I think the things that you mentioned, right? I mean, where the valuation. I mean, one could argue that even these guys have had a tear for the last 10 years, right? I mean, of course, it's outside the listed space, but a tremendous boost in valuations because in the last 10 years. And now there is a cooling off. I mean, but again, I'm not saying that's entirely a justified argument. But I'm saying that the management conduct, the temperament, the discipline and the diligence, because a lot of what the market pays for is the trust and the likability, not just potential, right? I mean, it's
there. I think, Sriram, what is happening there too much in our face. Whereas in reality, if you see even take a typical engineering company, take any old economy company, how they conduct themselves when the first time they get listed, or when they are slightly when the general institutional maturity is lacking. But sometimes they don't get that much attention, and maybe also, of course, they do get listed at a much lower market cap, which I must agree is not an apple to apple comparison. But I think these guys are too much in the limelight, and I think at that point in time they're struggling to manage.
I think that's when you get that limelight, and to show that humility is the
Absolutely.
most important bit.
Yeah, absolutely. The news flow is just not helping, for sure.
Yeah. So one question I have, Aashish, is that going into the next 1 year or so, right? This I wanted to sort of, okay, I had a brain freeze. Ashish, yes, I'll just phrase that question and come back. Why don't you take it?
Yeah. In the meantime, if any of the listeners they have a question, feel free to hit us up with your requests, and we'll give you the speaker access.
Hello. Hello.
Yeah, hi.
Hey. Oh, okay. Does someone have a question?
I
Yes.
think either we have, I think either we have confused or convinced because there are no questions.
Okay, so I'll jump to my question. I just was looking away for a second. Ashish, so the question was that when we are sort of again assuming that the war ends and everything's go back to normal. Normal, when I say normal, I mean just as it was before the war, right? Which basically means that um, sort of the hyper growth post COVID, right? I mean, the base effect kicking into global growth, commodity prices sort of stabilizing, China sort of, the place that it was where people were sort of adjusting their portfolios, taking some money out of China and putting it elsewhere. And in that current scenario, and US, of course, being in the inflation rate hike cycle, would that be a problem for a lot of Indian companies? And because I think it's been so long since we had this fear that I think people might have forgotten. But when US interest rates rise, a lot of the dollar strengthens, a
Am
lot
I
of the
am I
foreign.
audible, right?
Yes, yes,
Uh,
yes. Yeah,
Oh,
yeah. Now
sorry,
you are
sorry,
audible.
I had dropped out. Sorry, worst
Okay.
time to drop off.
So I was in the middle of a question. Okay. So Ashish, I was asking that when dollar strengthens and there is an interest rate hike in the US, a lot of companies that have borrowed money in dollar terms or in foreign currency, there is a larger outgo, right? You have to pay more rupees to repay the same loan installment, whether it is the
Yes.
interest or the principal, right? I think it's been some time since we've been in that cycle, so it might be a good sort of opportunity for us to refresh that memory, and sort of how do you see, what are the risks that you see? Which are the companies in, or if not companies, which sectors where you see high amount of foreign currency loans, and that could be one of the reasons why the margins could get squeezed in the months to come.
So, frankly, don't have company or sector specific data, but by and large, we would, if you really ask me in terms of our portfolios, two or three things that we would always keep in mind. So we believe in, basically what we believe strictly at White Oak is that we will not, we have zero confidence in our ability to forecast, macros specifically. So we'll never leave the portfolio exposed to a movement in currency one way or the other. So you will never find that, we have a portfolio which is full of export-oriented companies thinking that, current account deficit will go up, rupee will depreciate. On the other hand, you will never find us having a portfolio full of domestically oriented companies thinking that, the rupee is solid and, you know, uh, all these domestic businesses will do well, etc. So at any point in time, we'll try to have a portfolio which is absolutely balanced for any directional movement in the rupee or interest rates. So to that extent, and also, generally speaking, considering that we look for businesses which generate free cash flow over and above their cost of capital, generally speaking, companies which have very, very high leverage, and these, like typically large foreign borrowings, uh, high leverage, is not something which you would find in our portfolios. But on your question, I can tell you one thing, that we are not betting in either direction. We'll ensure that the portfolio is neutral to any of these occurrences.
Thanks, Ashish.
Puneet, giving you the speaker access. Go ahead.
Yeah, hi. Hi, thank you, sir, for sharing your insight. My question is, I was looking at Ambit's coffee can in portfolio. So all the names, I'm not talking about a specific portfolio, but in last 10 years, the return, 50% of the return came from PE expansion, 50% of those came from earning. So are you of an opinion that these would still remain at those elevated PE level? Because if they remain at those level, even then the returns from these name would be low because 50% came from earning expansion. So do you think something changing here, or it might even derate? So in that case, even the return would be lower. Do you think so, sir?
See, I think that one can never bet on PE expansion as an investment strategy. Okay, so I don't think that the guys out there, first of all, of course, it's above my pay grade to comment on anybody's strategy, but I'll take your question at face value. And I'll say that I don't think they are recommending that one should bet on PE expansions. And I don't think by and large anybody should be investing thinking that the PE will expand, right? Because that is not something in our control. PE expansion will depend on multiple things. It will depend on relative performance of stocks and sectors. It will depend on interest rates. It will depend on multiple things. But what we believe, frankly, we at White Oak, we actually don't use PE multiples. We use a completely different set of multiples, which is basically price to capital light free cash flow. So we look at free cash flow in excess of cost of capital. So we'll build a discounted cash flow model. We'll look at future projections of free cash flow, and we'll only value the business based on free cash flow generated in excess of cost of capital. So I don't want to complicate the discussion. The simple point is that PE multiple or EPS growth does not entirely explain stock price movement. What closest explains stock price growth is actually free cash flow over and above cost of capital. So when and a lot of these things, if you really ask me, this is what the data you narrated. That data is backward looking data. It only explains to you that till now when the price has moved, what has happened. And by the way, you should keep in mind that a PE multiple is always basically a PE multiple is a surrogate for longevity or visibility. I'm not saying the market is right, and we actually don't own most of these businesses, which probably are part of that strategy. So I have no vested interest either way, or either this way or the other. But the data which you said only explains what has happened in the past. But if the market has kept on raising their PE, one way to think is that the market is foolish and people don't know what the hell they are doing. They are overpaying for something. Other way to look at it is that probably the market is seeing something which by and large you are not seeing. That's why it is continuing to trade at that PE multiple. And that something else is likely to be free cash flow generation well in excess of cost of capital, right? So I would say that I don't know whether their PE multiples will sustain or not. I'm just trying to say that the way people have explained it as half EPS growth and half PE growth, I'm just trying to add another nuance to it, that these PEs and EPS doesn't fully explain stock price movements. If you're confounded by the stock price movement, thinking that how can it be half because of PE re-rating, then you need to look somewhere else, which most likely to be is free cash flow. And also, I would not be in any camp, like I would not assume the market, right? But if the market consistently rates such companies higher, then we have to try to understand it better. We may or may not buy it, but we just have to try to understand it better. Short term, ultimately in the long end, ultimately at the long term, the market does everything right. In the short term is when there are so many imperfections, and we need to understand that.
Aashish, I have one question on that free cash flow calculation. Because you said that you have a stake in some of these new age tech companies. How would you then sort of justify, if your investment strategy is based on cash flows and net cash flows, and how do you make the decision to invest in a Zomato, Paytm, etc., where the cash burn, it's not a cash flow, it's more of a cash burn business?
Yeah, no, so just on that specific thing, we actually do not have exposure to Paytm or any fintech company that you mentioned. But just to clarify, like how would it come through? See, because whenever you're making a DCF or whenever you're obviously projecting into the future, you're obviously hypothesizing. You're obviously hypothesizing at some point in time when it would turn positive on a free cash flow basis. That is one. And right now, obviously, you would in your modeling you would build that till what point in time you expect them to be in an investment mode, and at what point in time there would be a crossover, and you would actually expect them to generate free cash flow. So obviously, you are making a DCF. And also, DCF itself has become a bad word. So let me clarify: not up to 2041 or something, because
That was going to be my next question, but okay.
Yeah, so the thing is that see, any investment, we can't run away from this one fact that any investment you make is a hypothesis on the future. But of course, it has to be a qualified hypothesis after you do all your homework. Also, look, a lot of times, and this is something which I'm going to say is cliche, probably known to people, but I still worth repeating. That a lot of traditional businesses, they are looking profitable on an accounting basis, because a lot of traditional businesses, they put thousands of crores into, they create tangible assets. So you capitalize it and depreciate over 10, 15 years. But on cash flow basis, even they are significantly negative. They just start looking profitable on an accounting basis. Whereas these businesses in the last 5, 7 years, if they have been investing heavily, but you are not allowing them to capitalize anything. So actually, if you evaluate on a cash flow basis, traditional business and new business both would get seen from the same lens. The problem comes when you look at it on an accounting basis. That's where the
No, I think
difference is.
on a more fundamental, I mean, just to sort of dial it down just one notch for people like me, basically, I think comparing it with a manufacturing company would be different. I mean, we would probably do a better comparison with a service company, where
Sure.
like you said, the plant and machinery investment is lesser. But at the same time, I mean, how does that look when you compare it to a more service-oriented business and these
Yeah.
businesses?
So basically, you are hypothesizing that somewhere in the next 3 to 5 years, they will turn accretive. So you have to see now, what is your time horizon that you are looking to invest for. Also, let's keep in mind what percentage of your portfolio is in this. Because we run highly diversified portfolios. So some of these stocks would be 0.5% or 1% of the portfolio, and we would just be building positions. And then as the hypothesis plays out, we might dial up the positions. So for us, it's a gradual process, and it's a long term, as in 3 to 5 year thought process. It's not a 2041 process, and it's definitely not 3 months down the line kind of thought process. But essentially, we are building a certain valuation model which has customer acquisition costs, which has certain break-even points in terms of cash flow accretion. All of this built into the model.
Awesome. Thanks, Aashish.
Kamna, you can go ahead and ask your question. You're on mute right now. Puneet, do you have another question?
Yes, sir. So, sir, if it's not about anything to do with the white oak, but if the opportunity set is broadening, if the number of companies that are doing well broadens, so are you of an opinion that value theme should do better going forward? Because the kind of valuation people have been ascribing to some of the names, like even for that matter, names like Coal India. So do you think that if it broadens, then growth can take a back seat in this current scenario when the inflation is strong?
So, you clarified that you're not asking about my firm, but
Yes, sir.
but at our firm, frankly, we don't see. I have always held the belief that value is basically mispriced growth. At some level, see, we are not. Let's be very clear. Who is the father of value investing? Who's thought to be the father of value investing? It's basically Benjamin Graham. He wrote the book in 1949.
Correct.
Correct. Now, I just want to say one thing, that if you and me read this book in 2022, we should not assume that the market has gone back to 1949. So what was thought to be value at a certain point in time is not what value is today, right? When the traditional value thought process came, at that time there was a lot of information asymmetry. There was very poor institutionalization. The private market was practically absent, and the number of ways to raise capital was very, very, very limited. It was either just debt or equity. So from there, the market has changed quite dramatically, and it's become far more institutionalized, far more efficient, right, and far more evolved in terms of how people look at markets. There are very many institutional investors who take 10, 20-year views also on countries and sectors. So what people think that, growth, value, growth, we should not confuse ourselves with that. Anybody who's actually looking for value at some point in time, ultimately the profitability has to come in. You're not investing for a short-term value pop. If you are somebody who's making a hypothesis of next 3 to 5 years, ultimately the earnings and the cash flow has to come through. But I understand where your question is coming from. It's already happened, right? Last year. Like if you see some of the traditional businesses, for instance, or say, let's look at it this way. If you take the market color, then what worked very, very well in 2020, any mutual fund manager, any PMS manager who did very, very well in 2020, a lot of them or most of them actually underperformed in 2021. And the guys who did very badly in 2020, early part, they actually outperformed in a big way in 2021. So what you're alluding to as rotation between growth-oriented or quality-oriented businesses versus so-called old economy businesses, that is how we as a outside observer, that is how all of us, to make life easier, that is how all of us seem to be classifying stocks. And to an extent, what you said, it did happen, right? Between 2020 and 2021. It's already happened. In some ways, it's already started. But I think we should see that more as economic prospects, or we should think of it more as what the market is pricing in terms of economic performance or corporate growth. We should not confuse ourselves with being a value investor or a growth investor in that sense, because those stark differentiation or stark demarcations between traditionally what was value and what was growth, that is already killed. That has changed, or those differences are not as stark as what it used to be in the past.
Also, the agility of the fund managers, right, Aashish?
Absolutely.
The people.
So, Sriram, actually, so at White Oak, for instance, we will not classify ourselves as growth or value. We'll basically ensure we have a balanced portfolio construction. Our betas will be close to 0.9. Because typically what people say as value investor, their betas are 1.1, 1.2. Typically what people say as quality oriented investor, their betas are 0.7. So when you have high beta or low beta, you've done your stock picking, everything is perfect. But when you have a high beta or a low beta, in it implicitly, it is baked in that you will do well when the market cycle is headwinded or tailwinded. Now we don't want to bet on market cycle also. So we are not growth or value defensive or cyclical. We'll ensure that our betas are in the range of 0.9 or 0.92. And it's the stock picking that should work rather than the market cycle being headwinded or tailwinded. So we will always be balanced. We'll have pro-cyclical and counter-cyclical for almost every macro.
All right. If there are any more questions, guys, hit us up, or else we'll wrap it up over here. Srinath?
Yeah, I'm good. I mean, I can keep go on and on, but I'm sure everybody has a life unlike mine. So, let's move on. Yeah. Thanks, Aashish.
Yeah.
I hope you enjoyed it. I
Thanks
totally
for
loved
having
it.
me.
Yes.
Thank you, Aashish. That was a really engaging session filled with lots of learnings, and thank you for sharing your thoughts. In case, guys, you missed joining earlier, we will be posting the recording of the Spaces session on our Twitter handle. So it will be the first pinned post on StockTwits, and we highly recommend you go back and listen to Aashish's take on markets, individual sectors, and more. And also, FYI, guys, we do these spaces every Wednesday. So if you're new, do not forget to follow us on Twitter and all the other social media handles, and sign up to our daily newsletter as well to stay up to date with the markets. This is your host, Yash Upadhyay, signing off. Invest safe and peace.
Thank you.
Thanks, Aashish.
Thank you, everyone. Bye.